Let us see the next question. Following information are available in respect of, highlight the portion, XYZ Ltd. So the information is provided about a company called XYZ Ltd, which is expected to grow at a higher rate for 2 years. So the growth rate is going to be high for 2 years, after which the growth rate will stabilize at a lower level. So high growth rate for the 2 years, and afterwards the growth rate will stabilize. Highlight the portion, base year information. Means information is provided to us in respect of year 0. Revenue is provided to us. Operating income is provided to us. Capital expenditure is given. Amount of depreciation is given. Information for high growth and stable growth period are as follows. So the information is provided to us about the high growth and the stable growth. Growth is provided in terms of the revenue, that is sales, and EBIT, that is operating income. During high growth period it will be 20%, and later on it will be 9%. Growth in the capital expenditure and depreciation is 20%. During stable growth period, capital expenditure are offset by depreciation. It means that whatever is the amount of depreciation itself is the amount of the capital expenditure. The risk-free rate of return, RF, during this period it is 10% and later on 9%. Beta of equity is given to us 1.15 and then 1. Market risk premium is given, it is RM minus RF. It is 6 and later on it is 5. Pre-tax cost of debt is given. It means that the rate of interest information is given. It is 13 and 12.86. Debt to equity ratio 1:1 and later on 2:3. For all time, working capital is 25% of the sales. Income tax rate is only 30%. Assume that, highlight the portion, end of year 3 free cash flow will grow at a constant rate for perpetuity. What is the value of the firm? That is a question. I request all of you to go through the question and then we'll discuss how to do it. Please go through the question. Let us have understanding that's how to make calculation of answer for this very simple question. Dear students, remember that whenever we have been provided with the information like capital expenditure, depreciation, working capital, then in that case we always have to follow the free cash flow approach for the purpose of valuation. So over here we are required to make the calculation by using free cash flow for firm approach. Yes. Why free cash flow for the firm approach? Because we are required to make the calculation of the value of the firm. Generally we are having, listen carefully, generally we are having, say, the earning capitalization method, wherein net operating profit after taxes is discounted with weighted average cost of capital. This is the earning capitalization method. However, over here we are required to make the computation by using the free cash flow for equity method. That is what, free cash flow for the firm method. That is what we understand. Its calculation is extremely simple. Everybody is requested to pay attention. We start with the earning before interest and taxes. We make the computation of the income tax. Then we make the calculation of earning before interest and after taxes. Then we add back depreciation. Why? Because it is a non-cash item. Then we compute CFAT, cash flow after taxes before interest. That is what we do. Then there are two adjustments that we are required to make. One is capital expenditure and another is the working capital change. These are the two adjustments to be made to cash flow after taxes and before interest, and afterwards we will have free cash flow for firm. Whatever the free cash flow for the firm that say we compute, it will be discounted importantly using the weighted average cost of capital or using the overall cost of capital. That is what we understand. That is the way we are required to compute the value of the firm. Dear students, will make the calculation of this free cash flow for the firm for the first year, for the second year, and even for the third year. Whatever the free cash flow for the firm for the third year is going to grow at the rate of, like at a constant rate for perpetuity, which is provided to us at the rate of 9%. So we'll make the calculation of the P2 using free cash flow for the firm for the third year divided by weighted average cost of capital or overall cost of capital minus growth rate. That is the way the P2 is calculated. First and second year cash flow and P2, all of them will be discounted to year 0, and with that so we'll make the calculation of the value of the firm. That is the process which we are required to adopt for valuation of the firm. Dear students, you can see that so the information about the risk-free rate of interest is changing, beta is changing, RM minus RF is changing, rate of interest is changing, capital structure is changing. So basically we are required to make the computation of two weighted average cost of capital during the first 2 years, and say for the purpose of discounting the third year onwards cash flow. That is the way we are required to make the computation of the weighted average cost of capital, say for like the two separate cash flows for the first and second year, and from the third year onwards for perpetuity. That is what we understand. So let us make the calculation of the answer, and based on that so we are going to have further understanding, and individually also we are going to discuss the working notes. Read on heading calculation of value of the firm. In that, write down first point. Value of firm is calculated by different methods, comma, in this example we will find answer using free cash flow for firm approach. Second point, whenever information is given about capital expenditure and working capital, comma, we will use free cash flow approach for decision making, for valuation. third. Importantly, no financial charge will be deducted in calculating free cash flow for firm. Full stop. Friends, the reason for that is very simple. The effect of the discounting factor is already incorporated in weighted average cost of capital. And we understand that, say, we are doing the firm valuation. So all long-term sources of finance are taken together. That is the reason so the financial charges are not deducted. With respect to the interest payment, the advantage of the interest tax saving is considered in like the cost of debt financing. Because in weighted average cost of capital, cost of debt financing is taken on the post-tax basis. Free cash flow for firm will be discounted with weighted average cost of capital. Fine. Now write down heading. Step number 1. Calculation of WACC. In that write down working note number 1. Calculation of KD. It is rate of interest into 1 minus tax rate. As far as the rate of interest is concerned, for first and second year and third year onwards, that is the way we will have the bifurcation. For first and second year, the rate of interest is provided to us as 13% and income tax rate is given only 30%. That is what provided to us. This is 13% and this is 30%. (13% into 0.7), that comes to 9.1. Third year onwards for perpetuity, in that it is 12.86% into 1 minus 0.3. 12.86% into 0.7. That comes to 9%. So over here 12.86 into 0.7, that comes to 9.002, that comes to 9%. That is the way we make the computation of the cost of debt financing. Next, working note number 2, calculation of cost of equity. It is RF plus beta into RM minus RF. That is the way we make the calculation. Again, there are two things. One is say for the first and second year, and over here year 3 onwards. That is where the cost of equity is found. Now for first and second year, we have to use this information which they have provided to us. One is the risk-free rate of return, that is 10%. Then beta, it is 1.15, and market risk premium is say 6%. This information is going to be used. So we understand that the beta is 1.15 into RM minus RF is 6. So product of both of them is 6.9 plus risk-free rate of return is 10. That comes to 16.9%. That is the way we can compute the cost of equity. So over here, cost of equity is found as RF plus beta into RM minus RF. In that, the risk-free rate of return is given to us as 10. Beta is 1.15 into market risk premium is 6. So 10 plus 6.9. That comes to 16. That is the way the cost of equity is found. Year 3 onwards, in that case it is 9 plus 1 into 5. So 9 plus 5, that comes to 14%. That is the way the cost of equity is calculated. Once you make the calculation of the cost of equity, afterwards we are required to make the calculation of the weighted average or overall cost of capital. So working note number 3. Calculation of weighted average cost of capital or overall cost of capital. That is what we are required to find. In that, once again we will have the working for first of all year 1 and year 2, and then we'll do it say for the third year onwards. Calculation of weighted average cost of capital. In that, year 1 and year 2, we have been provided with the information about the debt equity ratio 1:1. So source of finance is column number 1. Then proportion. See over here it is debt equity. It is 1:1. So 1 divided by 1 plus 1. That comes to 0.5. 1 divided by 1 plus 1. That comes to again 0.5. So the total would be 1. So weight or proportion will be 0.5 multiplying with the respective cost. The question is providing the information that the cost of debt financing is 9.1 and this is 16.9. So this is 9.1 and this is 16.9. So proportion into cost of capital. So use a calculator. 0.5 into 9.1, that comes to 4.55, and 0.5 into 16.9 is 8.45. So the total will be 13%. This is the weighted average cost of capital or this is overall cost of capital. Please take down answer. So after making calculation of weighted average cost of capital for year 1 and year 2, let us see calculation of weighted average cost of capital year 3 onwards. Forever. So column number 1 will be again source of finance. Column number 2 will be weight or proportion. Next column will be cost of capital weight into cost of capital. In source of finance, we will have debt financing, equity financing. It has been given it is 2:3. So 2 divided by 2 plus 3, that comes to 0.4, and 3 divided by again 2 plus 3, that comes to 0.6. So the total will be obviously 1. That is the way the weights will be bifurcated. Multiplying with the respective cost. As far as the cost of debt financing is concerned, it is 9, and cost of equity is 14. So this is 9, this is 14. So 0.4 into 9, that comes to 3.6. 0.6 into 14, that is 8.4. So the weighted average would be 12%. That is the way the weighted average or overall cost of capital will be calculated. So that is the way the weighted average cost of capital can be calculated. Next, this is the step number 1, in which we have made the calculation of the weighted average cost of capital. For that, say the cost of individual source of finance is found, multiplying with the respective cost, that is say the weight. That is the way the weighted average cost of capital is calculated. Now step number 2, write an answer along with me. Calculation of free cash flow for firm. This is step number 2. In that, write down working note number 1. Calculation of, first of all, in that we'll take the calculation of the working capital change. Dear students, will make this calculation for 3 years. So year 0, year 1, year 2, year 3. We'll make the calculation for 3 years. Sales information is provided to us. Year 0 revenue is given to us as 2000 crore. End of year 1 it has been given that it will grow at the rate of 20%. So it is 2000 into 1.20 raised to 1. That comes to 2400. Second year, it is 2000 into 1.20 raised to 2. That is 2880. Next year it will grow at the rate of 9%. That is 3139.2. That is the way the sales is like calculated. Why I have calculated the sales? Because the language of the question speaks like that. For all time, the working capital is 25% of the revenue. So whatever is the sales of the company, of that 25% is the working capital. So over here we'll mention the working capital. It is 25% of the revenue. So accordingly we'll find the working capital for year 0 to year 3 end. So it is 2000 into 0.25. That comes to 500. 2400 into 0.25. That comes to 600. Then 2880 into 0.25 once again. So that comes to 720. Next is 3139.20 into 0.25. that is 784.8. That is the way we'll calculate the working capital. So what we have to understand, friends, we have to understand, let's say this is the working capital investment that say we have made right now. That is the working capital investment that we have made right now. End of year 1 we require 600. We already have 500. So working capital change will be 100. That is an investment which is supposed to be made. Then again we understand that say we require 720. We already have 600. So there is an additional investment of 120. We require 784.8. We already have 720. So we have to make investment of 64.8. That is the way we are required to make the computation of the working capital. It is 784.8 minus 720. That is the way working capital change can be calculated. So basically this 100 is calculated as 600 minus 500. 720 is calculated as, 120 is calculated as 720 minus 600. That is the way working capital change is calculated from end of year 1 to end of year 3. So that is the working capital change. That is the first working note. Next will be calculation of free cash flow for firm year 1 to year 3. We'll make the calculation for the 3 years. In that say we will have the columns like this: particulars, then on the opposite side we will have year. First year, second year and third year. That is the way we'll have the 3 years. Next is, we'll start with the NOPAT, net operating profit after taxes. That is earning before interest and taxes into 1 minus income tax rate. That is the way we are required to find it. You can see that the information is provided to us. The base year operating income is rupees 300 crore. That is year 0. It will grow at the rate of 20%, and income tax rate is provided as 30%. So for the first year, listen carefully, for the first year it will be found like this: 300 crore into 1.20 raised to 1, that is say operating income at the end of the first year, into 1 minus income tax rate at the rate of 30%. This is what's the answer of the first year. For the second year, what will happen? We understand that say 300 into 1.2 into 0.7, that is 252 crore. For the second year, dear students, it is 252 into 1.20 raised to 1 directly. So we understand that it is 302.4. Or otherwise, if at all you want to do detailed, then in that case for the second year it will be 300 crore into 1.20 raised to 2 into 1 minus 0.30. That is the way we'll have the operating income on post-tax basis for the second year. For the third year it will be again 302.4 into 1.09 raised to 1. Why? Because the growth rate is provided to us as 9% afterwards. Or otherwise again you can calculate the answer like this: 300 into 1.20 raised to 2 into 1.09 into 1 minus 0.30. That is the way we'll have the NOPAT from end of year 1 to end of year 3. Try to calculate the free cash flow for the firm for the first year and put your answer in the chat box. Now friends, let us have understanding. There are two things that we are required to mention. One we are required to mention is the growth in the capital expenditure. which is provided as 20% during the growth period. So capital expenditure is 280. So we can mention over here capital expenditure. (280 into 1.20 raised to 1). 280 into 1.20 raised to 2. That comes to 336. 403.2. Then we understand that say there is depreciation cash inflow. It is 200 crore into 1.20 raised to 1, and again 200 crore into 1.20 raised to 2. So the first year it is 240 as inflow. For the second year it is 288 is again cash inflow. Now understand friends carefully what I am going to speak. 280 minus 200. You can see that say the base year, in the base year there is a capital expenditure of 80 crore net of the depreciation. 80 into 1.2, that comes to 96. That is what's the cash outflow at the end of year 1. Then 96 into 1.2, okay, that is 115.2. So what happens that say you compute difference of this two, 403.2 minus 288, that is 115.2. That is the way we will have the capital expenditure net of the depreciation for the second year. This is the way say we can also make the calculation for capital expenditure net of the depreciation. Next is the working capital change. Again that calculation is already made by us for the first year to third year. Dear students, over here language of the question speaks very clearly that capital expenditure will offset by the depreciation say from the third year onwards. So we are not mentioning over here anything in the third year. Now friends, you can see that say first year end working capital investment is 100, second year end it is 120, and third year it is 64.8. So we will mention over here 100, 120 and 64.8. We will make adjustment of all this, that is say net operating profit after taxes plus depreciation minus capital expenditure minus working capital change. That is the way we will calculate the free cash flow for firm. See, this is free cash flow for the firm. Why? Because the financial charges are not deducted. That is the reason. So kindly use your calculator. You can understand 252 minus 336 plus 240 minus 100. So the first year free cash flow for the firm would be 56. Second year same working will be repeated. In that 302.4 minus 403.2 plus 288 minus 120, that comes to 67.2. That is the way second year free cash flow for the firm will be calculated. Third year 302.4 302.4 into 1.09, that is 329.616. Minus 64.8, that comes to 264.816. This is the way we are required to make the calculation of the answer for free cash flow for the firm from end of year 1 to end of year 3. whatever the third year cash flow, that is going to grow at the rate of 9% for perpetuity. So based on that, we'll compute the P2 and then value of the firm. So this is the most important working note of this entire question. I just repeat this working. We start with the NOPAT, then we deduct the capital expenditure, we add depreciation, we deduct the working capital expense, that is a working capital investment, and based on that, say we compute the free cash flow for the firm. Okay. Now, step number 3. Calculation of value of the firm. Let us understand how to make the calculation of answer. In that working note number 1, calculation of P2. What do we understand with the term P2? End of year 3 onwards for perpetuity, whatever the cash flows that you are going to receive, all of them will be discounted to second year end. So free cash flow for the firm for the third year divided by weighted average cost of capital minus growth rate. Okay, what is the free cash flow for the firm for the third year? It is 264.816 divided by weighted average cost of capital minus growth rate. Now friends, for the purpose of weighted average cost of capital, we are having the two weighted average cost of capital for the first and second year and for the third year onwards. For the first and second year it is 13% and for the third year it is 12%. So what we will do, we'll use the 12% rate for the purpose of calculation of P2. So we will have over here rate as 12%. Minus growth rate is 0.09. That is the third year cash flow will grow at the rate of 9% for perpetuity. So the answer would be 264.816 divided by 3%, 8827.2. This is the present value at the end of the second year. That's it. You have got the first year cash flow, you have got the second year cash flow, you have got the P2. All of them will be discounted to year 0, and that is the way value of the firm can be calculated. So let us answer calculation of value of the firm. It is first year, it is second year. Free cash flow for the firm. Weighted average cost of capital. Now friends, over here, the weighted average cost of capital for the first and second year will be used. That is, weighted average cost of capital for the first and second year is 13%. It will be used for the purpose of calculating the present value. So let us use 13%. We'll compute the present value, and that is the way the value of the firm can be calculated. First year free cash flow for the firm is 56. Second year it is 67.2. P2 is 8827.2. Double 8894.4. Now using 13%, we'll have the discounting. First year factor is 0.8850. Second year it is 7831. So whatever the discounting factor that say we have found, first year 8850, second year 7831, that will be used for discounting. So it is 56 into 0.8850, that comes to 49.56. 8894.4, that is the second year, into 0.7831, that is 6965.20. That is the way the present value is found. So 49.56 plus 6965.20, that comes to 7014.76. That is the way the present value can be calculated. So the final, like the summary of the entire working. The very first thing that you have to understand that we are required to compute the value of the firm. Second thing that we understand is the capital expenditure, depreciation, working capital information is given. So always we have to understand that we have to adopt the free cash flow approach for the purpose of valuation of the firm. Third, in calculation of the free cash flow for the firm, we have to ignore the payment of the financial charges. Fourth, we'll discount the free cash flow for the firm, that is, we'll discount the free cash flows for the firm, say using the weighted average cost of capital. So the effect of all payment of the financial charges would be covered in the weighted average cost of capital, including whatever the interest that we are supposed to pay, and its tax effect in a way that the interest tax saving would be covered in weighted average cost of capital. This is the basic mindset that we should be having for the purpose of doing answer. Going further in this question, we have been provided with the two separate the kind of the information for the high growth period and for stable growth period. For the high growth period, that is first and second year, information is provided, and for the third year onwards for perpetuity, again some information is provided to us. That is the way it is divided into two parts. In step number 1, it's extremely simple. We know that there are two segments of the cash flows. So we are making the weighted average cost of capital calculation for the first segment and weighted average cost of capital for the second segment. That is the way for two different segments, weighted average cost of capital is calculated. So we calculate the KD, we calculate the KE, we apply the weighted average. It is extremely simple, the kind of working that we may be doing at our second level. That is the way the weighted average cost of capital is found. Now you have to be little bit careful that whenever we are required to make the calculation of P2, then year 3 onwards for perpetuity, the discounting rate will be used, and for year 1 and year 2, we'll use 13% as a discounting factor. So be careful for this point. Free cash flow for the firm, in that there is a small working note of the working capital change. This time it has been given that the working capital is connected with the sales. Sales is growing, along with that the working capital. So difference of the working capital investment is the working capital change for the first year, for second year, and for third year. Free cash flow for the firm is calculated from end of year 1 to end of year 3. First year, second year, third year. For the first year, it is like the 300 crore growing at the rate of 20% and making it post-tax. Then it is growing at 20% and then it is growing at the rate of 9%. Capital expenditure, depreciation, both of them are growing in the first and second year. Third year onwards, whatever the amount of the capital expenditure that you have to make, itself is the depreciation cash inflow. So both of them will set off against one another. Then working capital change, simple information, that is what we already have found. Then free cash flow for the firm. Step number 3, value of the firm. In that, first of all, we'll make the calculation of P2. What does P2 mean? P2 means end of year 3 onwards for perpetuity, whatever you are going to receive, all of them are discounted to the second year end. That is the P2, 8827.20. Lastly, we'll make the calculation of the value of the firm, in which first and second year absolute amount of the cash flow discounted, and then the second year P2 value will be again discounted. That is the way value of the firm is calculated.